Welcome to the State and County Pre-Retirement video. This video is designed to provide assistance and information for members who are planning on retiring soon. We will cover the basics of the plan design and your options at retirement or termination. In addition, we will be creating and adding additional videos to our website covering the voluntary deferred compensation plan, Medicare, and Social Security. To begin, let's talk about the Retirement Office and how to contact us. The Nebraska Public Employees Retirement System, or NPERS, is the state agency that administers both the state and the county retirement plans. We're located in Lincoln. We're at 1526 K Street, Suite 400. We have a call center. If you've got questions about your account, you can give us a call on either of those two numbers. We also have a fax machine if you need to fax something to us, and our website address is listed on that slide. Now, NPERS is not the only entity that works with our retirement plan. There is also a plan record keeper, and the plan record keeper is currently emeritus. The plan record keeper is responsible for tracking account balances of member accounts. If you're in a plan where you can make investment changes, they handle those changes, transfers, distributions from your account, and also the quarterly statements that you receive. But if you have questions about your retirement benefit or your account, you should contact NPERS, not Emeritus, the plan record keeper. This is the main or the home page of NPERS website. Information is available in the form of videos, publications such as newsletters about your retirement plan and the retirement plan benefits. Forms are available also on our website. When we are conducting seminars, the seminar schedules are available on the website along with the seminar enrollment brochures. We also have a link to Emeritus on our website and links to the plan's benefit estimator. Let's talk briefly about the online account access buttons that are available on our website. There are two separate online account accesses that are available to state and county members. NPERS Online or Emeritus, the plan record keeper online. And those are two separate logins, which is why there's two separate buttons on our home page. If you create an NPERS Online account prior to retirement, the main functionality that you have is that you can review the beneficiaries that you've designated for your retirement account. The Emeritus Online Access provides you with additional information about your account. It'll show you your account balances. You can access your quarterly statements online. If you're in the retirement plans that allow you to make investment elections, you can do that online, and you can review your investment performance through the Emeritus Online Account Access. Let's begin talking about the benefits now. Now, the state and the county retirement plans are two separate plans, but the design of the two plans are essentially the same. And we're going to talk primarily in this video about the mandatory retirement plans for state and county members, which are the cash balance plans or the defined contribution plans. We will discuss the voluntary deferred compensation plan in a separate video available on our website. Cash balance, the original Tier 1, was created by the unicameral in 2002, and it went into effect on January 1st, 2003. So if you are a state or county employee hired on or after that date, you are participating in the cash balance plan design. Prior to that date, you would have participated in defined contribution, the older plan. And when cash balance went into effect, the unicameral opened up a window for people who are already participating in the older defined contribution plan to decide if they wanted to keep the defined contribution benefit that they had at that time, or if they wished to convert over and participate in the newer cash balance plan design. At that time, about a third of defined contribution members converted over to the newer cash balance plan. In 2007, another bill was passed by the unicameral that opened up a second one-time window where individuals who are still in the older defined contribution plan could participate by transferring over to cash balance. And in 2012, a third bill was passed by the unicameral that opened up a final window for individuals who are in defined contribution to convert over to cash balance. In 2018, another bill was passed by the unicameral that created a second tier of benefits in cash balance. So as of the time of this video, we do have state and county members participating still in the older defined contribution plan. We have individuals in Tier 1 of cash balance and individuals in Tier 2 of cash balance. Several sections of the plan design are the same. As we go through this video, when we get to the sections that are different, we will point out those differences between those three plans. The contribution rates are the same, whether you're in cash balance or defined contribution, but the contribution rates are different depending on if you're a state or a county plan member. If you are a state plan member, your contribution rate is 4.8% of your gross salary. You contribute that on a pre-tax basis to your account, and your employer, the state, matches that at 156%. If you are a county participant, you contribute 4.5% pre-tax of your gross salary, and the county matches that at 150%. Those contribution rates are set by state statute, and members cannot contribute more or less to their mandatory retirement plans. Let's discuss vesting now. Vesting is a good thing because when you terminate employment, if you are vested, you get to keep the employer match. If you terminate prior to being vested, you do not get the employer match. So how do you vest yourself? Well, there are different ways. Per statute, if you participate in the plans for 3 years, and they count that as 36 months of making contributions into the plan, then you are considered vested. And if you terminate employment, you'll be able to keep the employer match. Statute also stipulates that if you are age 55 or older and participating actively employed by the state or the county, then you are vested. So if an individual is hired on or after age 55, they begin plan participation on a vested status. Members will also be vested if they pass away while actively employed for the state or the county, or if they become disabled while actively employed for the state or the county. Let's talk now about the investments and the rates of return plan members receive on their accounts. This is one of the main differences between the cash balance and the defined contribution plan. So we'll begin with cash balance. If you're participating in the cash balance plan, either Tier 1 or Tier 2, you do not make investment decisions in this plan. Now, the money that you contribute and the matching dollars that your employer contributes to your account, those dollars are invested, but the investments are handled by the Nebraska Investment Council. And the rate of return that individuals receive on their cash balance accounts is not directly tied to the market performance of these investments. The rate of return that is credited to both cash balance Tier 1 and Tier 2 accounts is tied to the federal midterm rate with an additional 1.5% added on top of that. There is also a minimum rate of return if you're participating in the newer cash balance plan, and that minimum rate of return is 5%. So if you're in cash balance, you will never receive less than a 5% guaranteed minimum rate of return, and if the federal midterm rate goes up in the future, you could receive a higher rate of return than 5%. This plan also provides an enhanced annuity rate for individuals who elect to purchase an annuity from the state of Nebraska at retirement. Once you reach retirement age, you'll want to review this because that annuity rate is an integral design of the cash balance plan. It's a pretty big benefit if you're a cash balance member. Cash balance also has the potential to provide dividends for people participating in the plan. As I mentioned, the money in cash balance is invested by the Nebraska Investment Council. Those investment returns are used to provide that guaranteed rate of return for everybody participating in the plan. Every year, the state requires us to do an actuarial study of the plan's funded status. If the actuaries determine that there is adequate money in the plan due to positive investment returns, then the Public Employees Retirement Board can issue a dividend to individuals who are participating in the cash balance plan. Now let's talk about the older defined contribution plan design. This is actually a little bit simpler than the cash balance plan to explain, but it's a more complicated plan to participate in. Primarily because in the older defined contribution plan, you are responsible for making investment decisions. There is no guaranteed rate of return like in the newer cash balance plan. Members in the older defined contribution plan will see their account balances increase or decrease depending on the investment decisions that they have made and market performance during that time. NPERS does provide investment help. Now, we are unable to provide individual investment assistance to our plan members. That's something you need to be licensed to provide to individuals, and we are not licensed to do that. But we are able to provide you with general investment assistance. And the two main vehicles that we use for that are our annual investment report and then our investment education video. And both of those are available on our website. If you are participating in the older defined contribution plan, I strongly encourage you to review this information and make good, informed investment choices with your account. We've talked about the rates of return in your retirement account. Let's discuss now about designating beneficiaries. The beneficiaries that you designate are the individuals who receive any funds remaining in your account upon your death. So it's important to keep these beneficiaries updated because you want to make sure the proper individuals will receive these dollars upon your death. If you're a state employee, we want to make sure that you don't get confused. When you're going through open enrollment, you designate beneficiaries, and these are not beneficiaries for your retirement plan. The beneficiaries that you're designating during open enrollment are for the state's life insurance that's provided to state employees. The only way you can currently designate beneficiaries for your retirement account in both the state and the county plan is by using the NPERS Beneficiary Designation Form. And that form is available from your employer, or you can access it online at our website. To designate your beneficiaries, you need to complete that form, and then you'll have to sign it in front of a notary and have it notarized, and then mail the original form to our office. And remember, you need to keep these updated. So anytime you have a life event, such as a marriage or a divorce or the birth of the child or the death of an individual who you have listed as a beneficiary, it's always a good idea to fill out a new form, sign it in front of the notary, and submit it to our office. When we receive the new form in our office, it will take precedence over any prior beneficiary designation forms that you have submitted. And remember, if you create an NPERS online account, you can review who you currently have designated for your beneficiaries. When completing the beneficiary designation form, just a couple things to note here. In the upper right-hand corner of the form, you'll see a vertical column of boxes. That's where you designate which plan you're participating in that you want to designate beneficiaries for. Some of you may be participating in both the mandatory and the voluntary deferred compensation plan that the state offers. If you are, you can designate the same beneficiaries using one form for both of those plans by checking both of those boxes. Then after you mark the plan type, you'll put your member name and information there. And then underneath that are the two sections where you designate your primary and your contingent beneficiaries. Now, most individuals, if they are married, generally put their spouse as their primary beneficiary. And if they have children, Then they generally put the children in the contingent beneficiary section. Now, how you wish to designate your beneficiaries is entirely up to you. But remember, your primary beneficiaries are the individuals who will receive that death benefit upon your death. Contingent beneficiaries do not receive any death benefits unless all the primary beneficiaries have already predeceased you. A mistake we occasionally see people making is they believe that if they put down 2 primary beneficiaries and then contingent beneficiaries, that if one of the primary beneficiaries passes away, that share will revert down to the contingent beneficiaries. And let me clarify, that is not the way the beneficiary designation form works. In the example that I gave you, where if you have 2 primary beneficiaries, one of those beneficiaries predeceases you, then when you pass away, if you have not submitted a new beneficiary form, that sole remaining primary beneficiary will receive the entire death benefit. Again, to reiterate, contingent beneficiaries only receive a benefit when there are no primary beneficiaries alive at the time of the death of the member. Another thing I want to point out on the form too, when you look down the right-hand side of the form, you'll notice there are percentage marks. So let's say you are listing 2 primary beneficiaries. If you want them to share equally, you would write 50%, 50% in each of those sections. But maybe one of those primary beneficiaries you want to receive a larger percentage of the death benefit. So you could write 70% and 30%. Don't write 90% and 20%. Because that doesn't add up to 100%, and then we're going to have to send the form back to you. So please make sure when you're writing those percentages that it adds up to 100% for each section. Let's talk now about the difference between retirement versus termination. Per state statute, if you cease employment on or after age 55, you're considered retired. But if you terminate employment prior to your 55th birthday, you are considered terminated. Now, you have the same distribution options. You can take the money out of the account. There are 2 things that could be important, however. The first is if you're a state employee, if you terminate on or after your 55th birthday, there are additional benefits that you may have as a retiree, including potential continuation of your health insurance if you are carrying it through the state of Nebraska. Now, that continuation of your health insurance, if you're a state employee, is handled by the Department of Administrative Services. That is not handled by the retirement office, so you'll need to contact the Department of Administrative Services for information on that continuation of your health insurance. The thing that we can talk about is the tax penalties. If you take your money out prior to reaching retirement age, you may incur what are called early withdrawal penalties. Now, you are going to have to pay taxes on the distributions you take from your retirement account because you've been putting the money away on a pre-tax basis. So just get your brain wrapped around the concept that that money is going to be taxable income when you take it, regardless of what age you are. But what you want to avoid is taking it too early and suffering additional early withdrawal penalties. If you terminate employment in the year you turn 55, per the federal tax code, you can take distributions from your state or county retirement plan without early withdrawal penalties. But if you terminate employment prior to reaching the year you turn 55, you need to wait until you've reached age 59 and a half to avoid these early withdrawal penalties. Once you do terminate employment, you can begin taking money from your account, and the distribution options vary depending on if you are participating in the older defined contribution plan or if you're participating in the newer cash balance plan. If you're participating in the older defined contribution plan, your options are you may defer the account, you can begin taking distributions in the form of a lump sum or rollover, You can set up a systematic withdrawal if you're in the older defined contribution plan. You can purchase a monthly annuity from the state of Nebraska or do a combination of all of these options. If you are participating in the newer cash balance plan, there is a restriction on your distribution. In the new cash balance plan, you are limited to a one-time distribution that must include your entire account balance. Now, you do have multiple distribution options, however, that you can pick and choose from. You can purchase a monthly annuity, you can take a lump sum distribution, you can do a rollover, or you can do a combination of those three options. But again, you must take distribution of your full account using those options. You can, however, also defer your account if you're participating in the new cash balance plan. Now let's break out and discuss each of these distribution options. Let's begin with deferral. Deferral is available for both defined contribution and cash balance members. You may defer taking dollars from your account until you reach the required minimum distribution, or RMD age. Now, the RMD age can vary depending on when you were born, but once you reach RMD age, you are required by federal tax code to begin taking distributions from your account. And your RMD age is 70 and a half if you were born prior to July 1st, 1949, and your RMD age is 72 if you were born on or after July 1st, 1949. If you are participating in the older defined contribution plan, your account remains invested and you still have control over how those dollars are invested. And your account balance will increase or decrease depending on the investment choices that you have made and market performance during that time frame. If you are participating in the newer cash balance plan, you will still receive that midterm rate plus 1.5%, and you still will receive the guaranteed 5% minimum when the midterm rate falls below that. If you're in cash balance, you're also potentially eligible if a dividend is issued. We talked earlier about if the actuaries determine that the plan has adequate funding, the retirement board can issue a dividend to cash balance members. If you have deferred your cash balance account and you have an account balance on December 31st, then if the actuaries determine there is sufficient funds for a dividend, you would be eligible for the dividend. Now, because you've deferred your account, no taxes are due because you have not taken a distribution of your account. The next option is taking a lump sum distribution from your account. You can withdraw all or a portion of your account, and you can designate either a percentage or a dollar amount you'd like to take from the account. Is there a limit on the number of times you can request a distribution? Well, that depends on which plan you're participating in. If you're participating in the older defined contribution plan, there is no limit on the number of times that you can submit a request for a lump sum distribution. But remember, if you're participating in the newer cash balance plan, there is that one-time distribution limit. Because you are taking money out of your account now, it will be subject to income tax. And we are required by federal and state law to withhold 20% for federal income tax, and if you are a Nebraska resident, we have to withhold an additional 5% for Nebraska state income tax. Now, that may or may not be your actual tax liability. Your actual tax liability will be determined at the end of the year when you file your taxes, and it will be based on your adjusted gross income. So that 25% may or may not satisfy your tax liability. You should look at that 25% withholding as sort of a down payment or a deposit on your taxes. If your actual tax liability is less than that, you'll receive a refund when you file your taxes. But if your actual tax liability is higher, you'll have to pay an additional amount. And again, remember, there is the potential for additional tax penalties if you take those dollars out prior to reaching retirement age. Let's talk now about rollover distribution. You can roll over all or a portion of your account to an eligible retirement plan or traditional IRA. No taxes are due at the time of the rollover because you're merely moving that money from one tax-sheltered retirement account to another tax-sheltered retirement account. However, if you move the money to a Roth IRA, you will have to pay income tax at the time you do the conversion to the Roth IRA. Is there a limit on the number of rollovers? Well, this is similar to what we talked about with the lump sum distribution. If you are participating in the older defined contribution plan, there isn't a limit, but if you're participating in cash balance, you're limited to a one-time distribution of your account. Cash balance members who are participating in the state's voluntary deferred compensation plan also have the option that they can roll over their cash balance accounts to the voluntary deferred compensation plan. However, to do this, they must have established that voluntary retirement plan account prior to terminating employment. Let's talk now about the systematic withdrawal option. This is not available for cash balance, but it is available if you're participating in the older defined contribution plan. Under the systematic withdrawal, the minimum distribution is $100, and you can establish a monthly, quarterly, semi-annual, or annual automatic distribution from your account. And you can change the amount of that distribution or the frequency of the distribution a maximum of 2 times per year. The money remaining in your account after your automatic distributions remains invested, and there are taxes that will be withheld on the distributions that you take. And again, we're required by law to withhold 20% for federal and 5% for Nebraska if you are a Nebraska resident. Now let's talk about the monthly annuity. You may use all or a portion of your account to purchase an annuity. When you purchase the annuity from the state, the funds you have designated from your account are liquidated, and in return you receive a guaranteed monthly annuity payment. These payments will continue for your lifetime or a specific period of time, depending on the option you select. The amount of the monthly annuity is determined by several factors. Your account balance, or the amount that you've used to purchase the annuity. Obviously, the more money you designate from your account, the higher the monthly annuity benefit will be. Your age and the age of your beneficiaries. If you purchase an annuity that will pay you or them for their lifetime, we're going to look at your age when you begin the annuity payments. An individual who is older will receive a higher monthly annuity benefit than somebody who is younger, because the mortality tables tell us that we will not be paying the older individual out for as long of a period of time. The annuity rate is also a very big factor. Now, cash balance provides a higher annuity rate, and that's something we alluded to earlier when we talked about the design of the cash balance plan. Part of the investment returns in cash balance is used to provide a higher annuity benefit for individuals who elect to purchase an annuity at retirement. The current cash balance annuity rates are 7.75 if you fall under cash balance tier 1, and that rate is set in statute and it will not change. If you fall under tier 2 in cash balance, the annuity rate is 7.5%, and that rate could change if the actuary recommends a change to the retirement board. If you are participating in the older defined contribution plan, that rate fluctuates every year, and we post that in the January newsletter for the coming year. And then the annuity rate is locked in at the time you purchase the annuity. So if a change were to happen to the annuity rate after you've purchased your annuity, it would not affect the amount of the monthly annuity benefit you are receiving. And then the last thing that will affect the amount of your monthly annuity is the option that you select and whether or not you elect to purchase an annuity that has a cost of living adjustment. You have two choices, an annuity with or without that COLA adjustment. If you purchase an annuity without a COLA, cost of living adjustment, your very first monthly annuity benefit will be the same as the last monthly annuity benefit. It will never change over the life of the annuity. But if you purchase an annuity that has the COLA or the cost of living adjustment, that annuity will automatically increase 2.5% every year on the anniversary of the date that you purchased your annuity. Let's talk now about the annuity options. If you elect to purchase an annuity from the state, you will need to pick one of these options. And the option that you pick is important because it will determine to some degree how much money you receive in your monthly annuity payment, but probably more importantly, it will determine the potential for a death benefit. We'll begin with the life-only option. This is probably the easiest of all the annuity options to explain because there is no death benefit if a member purchases this annuity. The life-only does, however, provide them with a guaranteed payment for their lifetime. If you select the life-only option, you will not designate a beneficiary under this option, and this is the highest paying of all the lifetime annuities because there is no death benefit. The next option is the modified cash refund. Now, under the life-only option, it is possible that you might not get back the amount of money that you spent to purchase the annuity if you pass away sooner than anticipated. The modified cash refund annuity option kind of addresses that concern. It provides you with the guaranteed monthly payment for your lifetime. But if you do pass away before receiving payments equal to the amount you used to purchase the annuity, the remaining balance will be paid in a lump sum to your beneficiaries, or if you have no beneficiaries, to your estate. Under the modified cash refund annuity option, you may list as many beneficiaries as you wish, and you may change those beneficiaries at any time. The next option is the period, certain, and continuous. Again, under this option, it's a payment for your lifetime. And the potential death benefit then is based upon which one of those three options that you pick. So for example, if you pick the 5-year option, we're going to guarantee that if you pass away before receiving 5 years of annuity payments, and that's going to be 60 months, the remaining monthly annuity payments then are made to your beneficiaries or your estate. So for an example, if you purchase the 5-year annuity and you draw your annuity benefit for 4 years and then passed away, 1 year or 12 months of annuity benefit payments would be the death benefits issued. And then if you pick the 10-year option instead of the 5-year option, it works the same way. It's just that the death benefit time frame is extended out to 10 years instead of 5 years. And the 15-year option, again, works the same way, except you've extended the potential death benefit time frame out to 15 years. Now, of those three options, obviously the 15-year provides the highest potential death benefit payout because it has the longest payout time frame. But when you increase the potential death benefit payout under these annuity options, your monthly annuity amount will be actuarially reduced to offset the greater potential death benefit payout. And that's the main reason why the life only is the highest paying of the lifetime options, because again, it has no death benefit payout reduction. Let's talk now about the joint and survivor annuity. We also refer to this as the spousal annuity option. And this option has some positives and some negatives. Let's talk about the positives first. If you purchase this annuity option, you're guaranteeing a lifetime benefit not only for you but also for your spouse. And when we say spouse, we're talking about the person that you are legally married to when you purchase the annuity. And the way the annuity works is that when you pass away, your annuity transfers to your surviving spouse at either 50, 75, or 100% of what you were receiving. And you'll have to designate which one of these three options you want when you purchase the annuity. So this option provides a guaranteed lifetime payment not only for you, but also for your spouse. But on the negative side of it, when you purchase this annuity, you cannot change your beneficiary. As I just mentioned, your beneficiary when you purchase the annuity is the individual that you are legally married to at the time you purchase the annuity. And you cannot change that beneficiary, and you cannot add another beneficiary. So if your spouse predeceases you, you still will receive that annuity payment for the rest of your life, but when you pass away, there is no death benefit. The next option is the non-spousal joint and survivor annuity. This is very similar to the 50% spousal annuity option. The difference is that under this option, you can designate whoever you wish as your beneficiary. And when you pass away, if that individual is still alive, then the benefit transfers to them at 50% of what you were receiving, and they will receive it for the rest of their life. Under this option, you cannot designate more than one beneficiary, and you have to designate a human being as your beneficiary. And similar to the joint and survivor option, you cannot change or add another beneficiary after you've purchased the annuity. The final option is the designated period annuity, and this option does not provide you with a lifetime payment. All of the ones that we've talked about previously do give you that guaranteed lifetime benefit regardless of how long that you live. But under the designated period, it will pay you out for the time frame that you've purchased. And there are 4 choices there. You can pick a 5, 10, 15, or 20-year payment schedule. And under this option, you can designate whoever you want as beneficiaries, and you can change your beneficiaries at any time under the designated period annuities. This slide contains sample annuity dollar amounts that we created using our benefit estimator. We ran our benefit estimator 4 separate times, and each time we ran the estimator, we used the same annuity purchase price of $60,000, and each time we ran the estimator, we told it the person buying the annuity is age 65. This slide does a very good job of demonstrating 3 things. First of all, you can see how the monthly dollar amounts change based on the option that you select. If you look up and down each column, you can see the life only is the highest paying of these annuity options because it is the one that has no death benefit payout. If you look at the period certain and continuous, again, you can see the 5-year option, which has the lowest potential death benefit payout, pays out more money than the 15-year option, which has the higher potential death benefit. So you can see how actuarially these monthly dollar amounts are adjusted based on the option that you select and the potential there may or may not be a death benefit payout. The next thing this slide can demonstrate is the difference between buying the annuity with or without the cost of living or COLA adjustment. An individual who buys the annuity without the cost of living adjustment starts out with a higher monthly dollar amount, but remember that amount will never increase. It will stay the same for as long as they're drawing that annuity benefit. The individual who purchases the annuity with the COLA increase starts out at a lower dollar amount, but that annuity will increase 2.5% each year. And the third thing this slide demonstrates, and this may be the most important, is the difference between the cash balance annuity rate versus the older defined contribution plan. As you can see, it is a larger monthly amount that the individual will receive if they participate in the newer cash balance plan. We encourage you to go out and use our benefit estimator if you have not already done so. We used it to create that last slide, and this is a very handy tool to go out and plug in different dollar amounts, your age and your information, and see how much money you would receive if you elect to purchase an annuity at retirement. This slide shows you the first page of the benefit estimator. To use the estimator, you'll need to mouse click on the box indicating that you've read the disclaimer, and then click on the button of the estimator of the plan that you are participating in. This will take you to the estimator screen. On this screen, you'll input your data, and then at the bottom, click on Calculate Your Estimate. And then that will take you to the estimate screen showing you the different monthly amounts under each of the annuity options that we just explained. And you can click on the Your Information tab and alter the information that you plugged into the prior screen, so you may run multiple estimates using the benefit estimator. And then if you look at the bottom of the estimate information page, you can see the information that you plugged in, and you can print this page if you have a printer, or you can take a screen print of this to save it for your records. So if you've not used our benefit estimator and you're considering purchasing an annuity at retirement, I would encourage you to do so. That's a very handy tool to see how much money you would receive if you purchase an annuity at retirement. And before you purchase an annuity, and this is very important, you cannot cancel or change your annuity option after the annuity effective date. So before you purchase an annuity, you need to make sure you understand how these annuities work, because you cannot back out, you cannot ask for a refund of your money after you've purchased the annuity. We encourage you to consider your health and your family's health history, your other financial resources you will have during retirement, your risk tolerance, and the financial needs that you or other spouse or family members may have during your retirement. This is a very personal decision, and only you can decide if purchasing an annuity is a good choice for you during your retirement years. We encourage you to carefully study those annuities and annuity options before you make a purchase. If you do elect to purchase an annuity, you will have to pay taxes on each monthly annuity check. This is similar to how you're paying taxes right now out of your paycheck. Your employer withholds state and federal income tax from each paycheck depending on how you have filled out your W-4. When you purchase the annuity, there will be a tax withholding form similar to a W-4 where you will tell the retirement office how much you want withheld for federal and Nebraska state income taxes from each monthly annuity payment. You may change that monthly annuity withholding as desired by completing and submitting a new tax withholding form to our office, or if you have created an NPERS online account, you can change your withholding online. If you are not a Nebraska resident when you purchase an annuity, or if you move out of state, you'll need to notify our office and ask us to stop withholding Nebraska state income tax, and we will only withhold federal taxes. You may, however, be required to pay annuity taxes to the state that you move to, depending on that state's income tax laws. If you are required to pay state income taxes to your new state of residence, you'll need to contact their Department of Revenue to determine how to make those payments, as the state of Nebraska cannot withhold income tax for another state. Let's talk now about reemployment after retirement. The federal tax code requires state and county plan members to terminate in order to take benefits from their retirement account. And when we talk about benefits, we're talking about any distribution taken from your account. Nebraska statute says in order to take distributions, you must incur a bona fide termination of service. And per Nebraska statute, that means you have to have a minimum 120 calendar day break in service prior to being reemployed. During that time, you cannot provide service at any participating employer in the plan. So if you are a state employee, we are talking about all the state agencies that participate in the state retirement plan. Or if you are a Nebraska county employee, we're talking about all the Nebraska counties that participate in the plan. So during that initial 120 days, you cannot provide any service at those participating plan employers. And when we talk about no service, we're including paid or voluntary service, part-time, temporary, or seasonal. You also cannot enter into a prearranged return to employment if you are going to take distributions from your retirement account. Prearranging a return to work with your employer is not a bona fide termination, and you are ineligible to take distributions. This means any written or verbal agreement made prior to or during that 120-day break. You cannot agree in advance that you are going to resume service or employment after 120 days if you want to take distributions from your account. And this also includes agreements to provide paid, voluntary, part-time, temporary, or seasonal employment. If you are reemployed after you have incurred a bona fide termination as defined in statute, which means you've been gone at least 120 days and there was no prearranged agreement to return to work, then if you are reemployed, you will return to the plan you were previously participating in. So if you're in defined contribution, you will return to defined contribution plan participation. If you're in cash balance tier 1, you'll return to cash balance tier 1. If you're in cash balance tier 2, you'll return to cash balance tier 2. No further distributions can be taken from the account because now you again are actively employed. If you were previously vested, you will retain your vested status, but if you were not previously vested, then your vested status determines on whether or not you took a distribution from your account. If you did not take a distribution, in other words, you deferred your account, your vesting credit is granted for the time you previously had earned. But if you took a distribution from your account, you have lost that vesting credit. However, you can repay the distribution that you took from the account to restore that vesting credit. I would encourage you to take a look at the plan handbook in the reemployment section. It has more information about reemployment and repaying that refund. The thing that we really want to point out is that you need to be very careful about returning to work if you've taken a distribution from your account. Because if you do not have a bona fide termination of service, you are not eligible to take that distribution. And that means you will be required to repay those dollars. And you will be required to repay the full amount taken, which will likely include interest. And if you are unable to repay those dollars, you could be looking at potential garnishment of assets, including other retirement plans that you may have outside your state or county retirement. So again, we really strongly encourage people to be very careful about these reemployment laws. These are federal tax code and Nebraska state regulations that we must follow to keep the plan and our plan members in compliance. Let's talk now about what happens when you terminate your state or county employment. The first thing that will happen is your employer will notify our office. They will submit something that we call a non-contributing member form. We will then send you a letter advising you that we have received notification from your employer that you have terminated employment, and now that you have terminated employment, here are your options that you have with your retirement account. Once you decide to begin taking distributions from your account, then you should contact our office. When you contact us, then we will send you the distribution paperwork. When you receive that paperwork, you'll complete it and return it to our office indicating how you want to take distribution from your account. If you elect to purchase an annuity, there is additional paperwork that we may need from you depending on the option that you select. We will need proof of age for you and a beneficiary if you select an annuity option that pays for a lifetime. And if you select the spousal annuity option, we will need proof of your marriage. Please be aware that no distributions may be taken from a state or a county retirement account until all contributions have been made and posted to your account by your employer. For this reason, individuals should assume that it will be approximately 60 to 90 days after their termination before they will be able to take the first distribution from their account. And finally, some retirement reminders. After you terminate employment and during your retirement years, first of all, it's very important that you keep your address up to date with the retirement office. We may have important documentation or tax information that we need to send to you every year. So if you move, make sure you notify NPERS of your new address. On our website, there is an address change form that you can utilize for that process. Secondly, be aware of required minimum distributions. It is your responsibility to understand when you must begin taking those distributions, calculating the amount of those distributions, and contacting our office to take those distributions. Failure to take these required minimum distributions may lead to tax penalties, and if you fail to take the distributions for a long enough period of time, it can result in your account being transferred to unclaimed property. And finally, remember to update your beneficiaries as needed, and you can use the beneficiary designation form for that on the NPERS website. I'd like to thank you for watching this video. I hope it's proven informative for you as you move into your retirement. And please remember, anytime you have questions, when in doubt, contact NPERS. We are here as a resource for you prior to and during your retirement years, so please do not hesitate to call us anytime you have questions.